You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose and the Loose. I hope you're doing well on this Monday. It's kind of interesting because today we're going to talk about how to reach over 200% return in your portfolio. And that would be kind of nice, right? Everybody would like to reach 200, 300, 400% return in their portfolio. And that idea came to me after a discussion I had on the YouTube channel, actually on the Dividend Guy YouTube channel. And the thing was, one viewers was saying, yeah, well, it's easier to handle a hit on the market. So suffering from a market crash of like 30, 40%, probably having like the financial crisis in mind, when you are already up by 2% or more. Which kind of makes sense, right? So you are able to take a hit when you're kind of like playing with the house money. So you've made your money and you're way ahead in your game. And then, yes, there's a setback, but it's probably easier to take when you're still in profit after the market crash. Well, first, let's talk about the market crash for a second before we get into that, how to generate that 200% return in the beginning. So market crashes most of the time are not like 50% and up. Like that happens very, very rarely or very, very specifically. So if you were well diversified in 2008 during the financial crisis or during the financial bubble, the tech bubble in 2000, if you were well diversified, you did not suffer from a 50% crash in your portfolio. That didn't happen that way. Actually, I was a financial planner in 2008, and my clients that had like investments that were very aggressive, so like 90% to 100% in equities, well, on that year, they were down like 27, 30%. They were not down 40, 50, 60% as a lot of people are saying. But of course, that if you were all in banks in the financial crisis, well, you were down more than that. If you add all your money into all the dot-coms in 2000, yes, you were probably, or in the NASDAQ, you were probably down like 70, 80%. But that's not having a strong strategy. It's not having a great diversification, right? So you're going to agree with me that if you are diversified, the likelihood, even if you're 100% in equities, I've been in 100% in equities since 2003, and I never saw my portfolio going down by 50%. Never, ever. I'm not saying it's not going to happen, but I'm just saying that if you're using this as a point of reference, you're actually using the exception as a point of reference. And then you will have to go back in time by a long mile to find those exceptions because they rarely happen. So that's the first thing. Now, how to reach 200% return? Well, it got me thinking about how sometimes reaching goals are coming with simple solution, but they're different. It's very difficult to reach those goals. So imagine that you want to lose weight. I mean, it is a challenging goal, but in the reality, the solution is to eat less and eat healthy food and do more activity, right? And if you do that, you're going to lose weight. If you want to build a business, well, you identify a problem and you offer a solution. If you want to retire stress-free, you pay yourself first and you invest systematically, right? That's pretty much like something that if you start doing in your 20s, well, you will retire at the age of 60, 65 with a pretty good nest egg without any other worries. So simple solution, but very difficult to reach. And why is that? Well, the problem on all of those goals and the problem of reaching 200, 300, 400% return on your portfolio is exactly the same. The solution is really simple. The problem is you must be consistent. You must apply that solution every single day for several days, several weeks, quarters, years, decades. And that's the only thing. So going back to 200%, well, I've done more than that with my investment so far. But as I said, I've been fully invested in the stock market since I started to have a single dollar in my portfolio. So in 2003, that was the year that I I completed my bachelor degree in finance and marketing, and then I started working. So that's why I started to invest. And if I had known what I know today, and this is how I started my children, I convinced them to start in their teenage years instead. So like they all started between the age 10 and 12, which is kind of amazing, right? They started investing very early. So they have like a 10 years ahead of what I did, and they will generate a lot more returns than me just because of that. Unless they skipped on the strategy, unless they become less consistent, unless they sell their equities when the market is like fit a little bit, that it's not like going towards a clear direction or there's a dip, and then they sell and they go back to fixed income, or they go back to fixed income because now they're offering like 4, 5, 6% interest rate, and they're thinking, oh, I'm done with the market, I'm just going to go back for fixed income. And then 2 years, 3 years later, fixed income offers like a 3% or 4% yield. And now they're just like, oh, I'm going to go back to stocks because now the fixed income are not offering enough. And if you just jump from one strategy to another, it's going to be very difficult to reach 200% mark return or even more. But what if you just stay the course? You stay invested. I never say that enough, right? You stick to a single strategy, a simple one. So it doesn't have to be dividend growth investing as I am focused on. Like that's the strategy I chose because I am confident in that strategy. My level of conviction when I invest is through the roof because I love to hold thriving companies that are showing growth potential, and they prove that to me by increasing the dividend. So that's why I'm a dividend growth investor. But maybe it's not your style, and that's totally fine. Maybe your style is index investing. So you have like 4 or 5 ETFs, or you just go with an all-in-one ETF. That may not be the perfect solution, but imagine your life if every time you have money, so money to invest, so like every 2 weeks, every month, whatever, you put that in that simple single strategy, and you don't ask yourself anything else. Is it the right time to invest? Should I cash in on my profit and protect my investment? Should I move to another strategy that looks more interesting? No. You just stay the course. You've selected a strategy and you keep on investing. Well, there you go. That's the secret to reach 200, 300, 400%. I know it's stupid, but I mean, it works. And I saw that in my portfolio. When I started investing, I was looking at other investors, and then I thought, wow, that's kind of crazy. They bought shares of like Procter & Gamble, and now they're up like 400% since they have been holding this for like years and decades. And oh yeah, that was the good times. I will never be able to do that now because now things have changed. Well, guess what? Now, 10, 15, 20 years after I started to invest in stocks, I look at those holdings and yeah, they are up multiple triple digit numbers like 100, 300, 400%. Even my Apple shares that I bought in 2004, so 2014, sorry. I wish I bought that in 2004. So 10 years later, I'm up like more than 1,000%. But there's no magic here and there's no genius here. It's just to keep on investing with the same strategy. If you have done that with like just index investing, following the S&P 500 and the TSX 60, you would be up by several 100% if you started like 20 years ago. But that's the key point, right? Stay invested and just keep on investing every single time you have money on the side. And this is how you're going to reach your goals. But if you keep on trying to find the right sector, the right trend, the right strategy, and you move from one strategy to another all the time. And I see that too often. And this is why I wanted to pull out this podcast this morning. Well, this is a recipe for disaster because by the time that you're switching from one strategy to another, you do not benefit from the compounding effect that the strategy had. So most of the time, people are doing this every 2, 3, 4 years. So that's not enough for any strategy to work well. So instead, here's a solution. Take a little bit more time to identify the strategy you want, to know yourself, know your risk tolerance, identify your financial goals, and then stick to that plan. And by sticking to that plan, you're going to reach it. It's going to be boring. It's not going to be exciting, but it is going to work. And there you go, Moose. All right, that's enough for today. I hope that you will have an amazing day. Please forward this episode to any of your friends that is always looking for another strategy. And just tell them, you surely have 10 minutes for this episode. Just for that, it would mean the world to me. And again, we're going to talk tomorrow morning. Until then, you know what? Don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.